In my last month's video, I talked about repo rate. I briefly touched upon how it controls inflation. And in this video, I'll be digging deeper into the Monetary Policy Committee, their purpose, their establishment, the members, their functioning, the instruments that they use to control inflation, so on and so forth. So without wasting any more time, let's get started with the video. Hello everyone, this is Debayan and I make videos for MBA students, MBA aspirants and MBA professionals. So if you are one of them or would like to receive content around them, then do subscribe to my channel as I keep coming up with videos on those topics. In this video, I'll be talking about monetary policy. Now, monetary policy is policy of the central bank to control inflation, to control the cash flow in the market, to control liquidity in the economy, and to ensure there is economic growth. So you must have read in the news about inflation and RBI coming up with their repo rates, changing their repo rates, changing their stance from accommodative to calibrated growth. So what are all this? I'll be explaining in this video. The instruments Monetary Policy Committee has to control inflation are firstly repo rate that I had discussed in my previous video. It is the rate at which the RBI disburses loans to the bank in case the banks have any shortfall in cash. Whenever these commercial banks need cash or they have any shortfall in their funds, they borrow from the RBI at a rate that is the repo rate. That rate is decided in the Monetary Policy Committee meeting. Now, in case the RBI wants to control inflation, in case the RBI wants to reduce the cash flow in the economy, they increase the repo rate, which makes it difficult for the banks to borrow funds from the RBI, borrow cash from the RBI, and in turn reduces the cash inflow in the market. And as the cash flow in the market reduces, the people have less money to spend in the market, people have less disposable income, which helps in controlling the inflation. If repo rate is increased, the banks pay a higher rate of interest, thus reducing the liquidity. And in case the repo rate is reduced, it will become easier for the banks to take loans from the RBI and disburse the cash into the economy. So if the repo rate decreases, the amount of interest taken by the commercial bank increases and there is high liquidity in the market, and that helps in boosting up the demand, that helps in the growth of the economy. So repo rate is one such instrument that the monetary policy uses to control inflation. The second instrument is the reverse repo rate. Reverse repo rate is the rate that RBI borrows loan from the commercial bank. In case they want to reduce the liquidity in the market, they raise the reverse repo rate, which makes it suitable for the banks to lend to RBI than lending into any other instruments or investing elsewhere. In this way, RBI curtails the liquidity in the market and helps in inflation. So repo rate and reverse repo rate are the two instruments, and usually the reverse repo rate is less than the repo rate. In FY22, the reverse repo rate wasn't changed while the repo rate kept on increasing. Next comes the cash reserve ratio. It is a percentage of banks' net demand and time liability with the RBI. So as the banks disburse loans and fixed deposits, their liability increases. In order to maintain safety, a certain portion of their total liability and total demand, they have to park it with the Reserve Bank of India. That is cash reserve ratio. Another similar instrument is the statutory liquidity ratio, SLR. SLR is the amount of money, and amount is a percentage of the total net demand and time liability of the bank that they need to maintain in liquid form like cash, gold or government securities. Now this helps in improving the liquidity of the bank, and changes in SLR helps in managing the available resources of the bank, and it enables the bank to lend to the private sector. Marginal standing facility is the tool used by the RBI under which the banks can borrow overnight loans. Now this helps the bank in absorbing any unforeseen shocks to their liquidity in the market. If their liquidity suddenly dips, and if there is any sudden change in the liquidity, they can avail loans from the RBI under the marginal standing facility, and the rates are again defined by the RBI. Next is the open market operations. Open market operations refer to the sale and purchase of government securities in order to infuse or absorb liquidity from the market. History of the Monetary Policy Committee meeting. Earlier, this repo rate was decided by the RBI governor alone, but to add transparency and make the monetary policy accountable, a monetary policy committee was formed. And the first monetary policy committee meeting was held in 2016. Committee is a 6-member committee chaired by the RBI governor and 5 other members from the ministry as well as the Reserve Bank of India. They are supposed to meet at least 4 times a year to discuss the inflation and growth in the market and decide on the rates to either increase the growth or to curtail inflation. Usually they meet once in 2 months, but if required, they can meet more than that as well. However, they are required to meet only once every quarter, that is once in every 3 months, 4 times a year. Now coming to the stances that the Monetary Policy Committee takes. There are 4 types of stances that the Reserve Bank of India takes. The first stance that they take is the accommodative stance. In case of minimal growth, in case the growth of the economy isn't as much as the RBI had expected, then they decide to keep their repo rates and reverse repo rates at the lowest possible so that more and more liquidity is infused in the market and the demand increases and the intended growth is achieved. During COVID, we must have heard the RBI having an accommodative stance, which meant they wanted the economy to grow, they wanted more and more money to be infused in the economy, which is why their repo rate and reverse repo rate were kept at a very lowest possible level. Next comes the neutral stand. In case when the inflation and the growth are going as expected, the inflations are well within the tolerance limit of 2 to 6%, then they do not change the reverse repo rate and the repo rate as frequently or at such a margin, and that is where the RBI said to be having a neutral stance towards the economy. The hawkish stance refers to the situation where the RBI is aggressively trying to control inflation and they increase the repo rate at a very aggressive level. This may in turn result in few economic events like unemployment or people having less disposable income. But whenever the RBI goes for a hawkish stance, their sole intention is to control inflation. And the fourth stance that they take is calibrated tightening. This situation comes when the RBI wants to control inflation, but instead of going hawkish, they are slowly increasing the rates, repo rates and reverse repo rates so as not to affect the economy in such a negative way. So calibrated tightening happens when the RBI wants to control inflation in a steady manner. So that was the video on the Reserve Bank of India's monetary policy and monetary policy committee. If you enjoy this video, then don't forget to like this video and subscribe to my channel. That really gives me a boost to come up with more and more videos. See you in my next video. Take care. Bye-bye.